Okay, so this video deals specifically with the expense payment fringe benefit, which is covered under Division 5 legislation. So the fringe benefit can arise in two ways. Firstly, if the employee pays an expense and is then reimbursed by the employer, then a fringe benefit will arise. So an example of this is, say, the employee goes and pays $100, I don't know, just on, say, a gym subscription, and the employer decides they want to reimburse that, then that would be a fringe benefit. Also, if the employer pays a supplier directly on behalf of the employee, a fringe benefit would arise. So an example of this might be that the employer wants to pay health insurance, for example, and so they pay an amount of money directly to the health insurer on behalf of the employee, then a fringe benefit would arise there. So the exemptions for the expense payment fringe benefit is a no private use declaration. So the employer can lodge a form which says that a particular benefit was only used for work purposes, so there was no actual private benefit derived by the employee. And so if that form's lodged, then the benefit becomes exempt. There's also exempt accommodation expenses. So these expenses are simply accommodation when an employee has to move or use alternative accommodation other than their main residence because of a requirement of their employment. So if the employee had to move interstate, for example, and so the employer reimbursed them for, say, rental costs, then that would be an exempt accommodation expense because they have moved purely because of the requirements of their employment. So there's also exempt car expenses. So if the employer decides that, they want to provide an amount for every, kilometer you drive just to reimburse some of the costs, and that becomes exempt. But the key to actually making it exempt is if the employer specifies an amount per kilometer that they're actually going to reimburse. That's the critical criteria for it actually being exempt. So then we've also got some Division 13 exemptions. So we've got 58H, newspapers and periodicals used for business purposes. Say, for example, you're interviewed on a morning television show and you're going to be asked about, some of the articles in the newspaper. Then the cost for these, for you to actually read them to make sure you're prepared for that interview, would be exempt because they're used for business purposes. 58M, straightforward. If there's any work-related medical examinations or screening, preventative healthcare, counselling and migrant language training, they're exempt. 58P, so any minor benefits, so ones less than $300 are exempt. However, if they're identical or similar benefits, they have a single $300 cap. So for example, if I bought for an employee 2 Christmas presents worth $170 each, because they're identical, or similar, they're both Christmas presents, that would total $340, and that would breach the $300 cap. However, if I paid $150 for a Christmas present and paid $200 for an employee to go to a Christmas party, they're two separate things and have their individual $300 caps, and so they would both be exempt. So 58X, eligible work-related items. So if the employee requires any of the items listed here, so portable electronic device, software, protective clothing, briefcase, or tool of trade for their work, and it's provided by the employer, then it's exempt. Okay. Also, we've got 58Y, any membership fees or subscriptions. So it has to be either one of these three: trade professional journals, an entitlement to corporate credit card, or an airport lounge membership. Any of those three things are exempt. Okay, so there's also 58Z. This is to do with taxi trips. So if any single taxi trip begins or ends at the place of work, then that's exempt. or if the taxi trip is a result of sickness or injury and you're going between your place of residence, your place of work, or somewhere relevant to your sickness or injury, such as a hospital or doctor, then it is exempt. Okay, so they're relatively straightforward. So now we move on to an example. So on 5 April 2016, Ben Limited paid $2,000 for their employee Tony's gym membership. Tony then paid $500 back to the company, as company policy specified they could only cover $1,500. Tony also bought $100 of work-related stationery. The company reimbursed this amount. Ben Limited is entitled to claim input tax credits for GST purposes. Okay, so we need to work out the taxable value. So for expense payment fringe benefits, the taxable value is equal to the amount of reimbursement or payment. So reductions to taxable value can come in the form of recipient contributions or the otherwise deductible rule. So in our example, the company has paid for $2,000 of health insurance for Tony. However, the policy specifies they only cover $1,500. So Tony then pays $500 back to his employer, and so that's his contribution as the recipient. So we've got the $2,000 for the health insurance, but Tony contributes $500, and so individually the health insurance has a taxable value of $1,500. Now there's also the otherwise deductible rule. So this rule is basically one that states that if the employee would be able to claim a work-related deduction on their own personal income tax, then the company is also able to claim a deduction for fringe benefits purposes. So the key question is, if the employee can claim a deduction for it, then the company is able to claim a deduction for it. So in our case, Tony bought $100 worth of work-related stationery. If he was to include that on his personal income tax return, he would be able to claim that as a work-related deduction. And as a result of this, the company is also able to claim it because they reimbursed him that $100. Tony can claim it, so the company can claim it. So this brings the taxable value of the stationery to $0. Okay, so our total taxable value for both items is $1,500. So next we need to gross up the taxable value. So the way we do this is by taking the taxable value multiplied by the gross up rate. So we're using the type 1 gross up rate because the company is entitled to input tax credits, and we know we need to use the FBT ended 31 March 2017 because I believe the date was the 5th of April 2016. So we've got $1,500 being taxable value multiplied by the gross up rate of 2.1463, and this comes to a total of $3,219 if we round it to the nearest dollar. Okay, so next we need to work out the fringe benefits tax payable. So the way we do this is we take up the grossed up taxable value, which we just calculated, and multiply it by the FBT rate. The grossed up tax value is 3,219, so we just did that. Now FBT rate is 49%. So the FBT year is 1st of April to 31 March every year. Our date was the 5th of April 2016, so that's included in the 2017 FBT year, or the one that ends 31 March 2017. So we've got to use 49%. So this calculation comes to $1,577 that the company would have to pay in fringe benefits tax. So I hope the video was useful, and good luck for any questions that you attempt.